All right, so we are now moving on to Learning Unit 2, and Learning Unit 2 is still part of Topic 1. Remember, for our curriculum, we are going to be covering 9 learning units. So we're going to be looking at 9 learning units, and now we're moving on to Learning Unit 2. And for Learning Unit 2, they say we should cover chapters 2, 3, and 4 of the textbook. So for Learning Unit 2, we need to make sure that we cover chapters 2, 3, and 4 of the textbook. So moving on to chapter 2 of the textbook. So if you move on to chapter 2 of the textbook, chapter 2 looks at analyzing banks from a market risk perspective. So we're looking at analyzing banks from a market risk perspective. And on the second paragraph on chapter 2, they say, today, most large banks engage in both commercial and investment banking. So commercial banking involves, among other things, the deposit taking and lending activities of we have just mentioned. Investment banking is concerned with assisting companies in raising debt and equity and providing advice on mergers and acquisitions, major corporate restructurings, and other corporate finance decisions. So large banks are also often involved in securities trading, that is by providing what? For example, by providing brokerage services. So commercial banking can be classified into retail banking and wholesale banking. So retail banking, as its name implies, involves taking a relatively small deposits from private individuals or small businesses and making relatively small loans to them. Also, banking involves the provision of banking services to medium and large corporate clients, fund managers, and other financial institutions. Both loans and deposits are much larger in wholesale banking than retail banking. And sometimes banks fund their lending by borrowing in financial markets themselves. So typically, the spread between the cost of funds and the lending rate is smaller for wholesale banking than retail banking. However, this tends to be offset by lower costs as well. So please take note of this, because potentially you can be asked this as what? Theory questions in the exam. So now the first thing that we're going to be looking at is commercial banking. And when you look at commercial banking, they say commercial banking in virtually all countries has been subject to a great deal of regulation. This is because most national governments consider it important that individuals and companies have confidence in the banking system. Among the issues addressed by regulation is the capital that the bank must keep, the activities that they are allowed to engage in, and deposit insurance, and the extent to which mergers and foreign ownership are allowed. On section 2.2, we look at capital requirements. So we look at capital requirements of a small commercial bank. And yet they say, to illustrate the role of capital in banking, we consider a hypothetical small community bank named Deposit and Loans Corporation, and in short, they put it as DLC. So DLC is primarily engaged in the traditional banking activities of taking deposits and making loans. A summary balance sheet of DLC at the end of 2018 is shown on table 2.2, and a summary of the income statement in 2018 is shown on table 2.3. So if you check on table 2.2, this is where they give us a summary of the balance sheet of DLC Bank. Now, when you look at the balance sheet of DLC Bank, we see that, remember, your assets is equal to equity and liabilities. So your assets are found on the left side of your balance sheet, and then your equity and liabilities, you find them on the right side of your balance sheet. Now, when you look at equity and liability side, this is where you look at the financing section of the bank. And then the asset side is basically the income generating side of where you find income generating activities of the bank as well. Now, on the liabilities network, we see that we have deposits that the bank has taken, and in this case, it's equal to 90 million. We have subordinated long-term debt, and it's equal to 5 million. And we also have equity capital, which is equal to 5 million. Then on the left side of the balance sheet, we have the cash, marketable securities, loans, and fixed assets as well, so that the asset would be equal to equity and liabilities. Then from there, when you look at table 2.3, they also give us the income statement of the bank. And on the income statement of the bank, they tell us that your net interest income is 3 million. Your loan losses, which are, remember, these items are going to discuss them in detail as well. Your loan losses are equal to 0.8 million. And your non-interest income is equal to 0.9 million, which is an income. And then your non-interest expense, which in this case is going to be 2.5 million. And this will give us a pre-tax operating income, which is equal to an amount of 0.6 million. Now, looking at the breakdown of these items, going back to table 2.2, they tell us that table 2.2 shows us the bank has 100 million in assets. And the 100 million in assets that they're talking about there is basically the cash, marketable securities, loans, and fixed assets. And from here, we see that the loans are making up 80 million of these fixed of these assets as well. So here they say, well, the bank has 100 million in assets, and most of the assets, which is 80% of the total, are loans made by the bank to private individuals and small corporations. Then cash and marketable securities account for 15% of the assets. So your cash in this case is equal to 5 million, and your marketable securities equals to 10 million. So 5 plus 10 gives you 15 million in what? Cash and marketable securities. So 15 of the total assets of 100 million would mean that your cash and marketable securities are making up what? 15% of your total assets. Then they say the remaining 5% of the assets are fixed assets, which would be your buildings or equipment, etc. So a total of 90% of the funding for the assets comes from deposits of one sort or another from the bank's customers. So when you're now looking at the equity and liabilities where the funding side is, they're basically saying that 90 million of the 100 million funding of the bank is basically made up of what? Depositors' inflows. Then they also go on to say a further 5% is financed by subordinated long-term debt. And in this case, the subordinated long-term debt that they're giving us there as a percentage is basically this debt, which is equal to 5 million. Then moving on, they say, and they also give us in brackets, they say, these are bonds issued by the bank to investors that rank below deposits in the event of liquidation. Then the remaining 5% is financed by the bank's shareholders in the form of equity capital. So the equity capital consists of the original cash investment in the shareholders, and the earnings retained in the bank. So do you see the makeup of the financing of the bank? That's why they say banks are highly leveraged in the sense that about 95% of the financing of the bank in this case is basically what? Debt financing. And only 5% of the bank in this case, or the financing of the bank, is basically what is making up the equity capital financing. So because of the high leverage nature of the bank, that's why you also find what? High regulation as well, because especially when it comes to depositors' money, for the for there to be maintained confidence in the financial system of an economy, we need to make sure that what the depositors' money is not going to be the depositors are not money is not going to be lost due to the activities of the bank, hence high regulation of the banks as well. And remember, because of this high regulation of high leverage of the bank as well, that's why you also see that there's also limitations on exactly what investment activities that the bank can be pursuing as well. So is there any question regarding the breakdown of the assets, and then which is the investment section and also the financing section of the balance sheet of this bank? Any questions? Now, moving on to discuss the income statement, they say consider next the income statement for 2018 shown on table 2.3, which is the table which is above here. And here they say the first item on the income statement is the net interest income, which is equal to 3 million. So this is the excess of interest earned over interest paid, and is 3% of the total assets in our example. Because remember, our assets are equal to 100 million. So as a percentage of our assets, our net interest income is equal to 3 million over the 100 million, which gives you 3% of the total assets. Then they also say it is important for the bank to be managed so that its net interest income remains roughly constant regardless of the movements in interest rates of different maturities. So we will discuss this in more detail in chapter 9. Then they also say the next item is loan losses. So this is 0.8% of the total assets for the year in question. And clearly it is important for the management to quantify the credit risks and manage them carefully. But however carefully a bank assesses the financial health of its clients before making a loan, it is inevitable that some borrowers will default. So this is what leads to loan losses. So the percentage of the loan that will default would tend to fluctuate from 1 year to year with economic conditions. So it is likely that in some years, default rates will be quite low, while in others, they will be quite high. The next item is non-interest income. And remember, the next item that they're talking about, after the loan losses, the next item is the non-interest income, which is equal to 0.9 million. And here they say, so the next item is non-interest income, consists of income from all the activities of the bank other than lending money. This includes fees for the services to the bank provides for its clients. In this case, DLC non-interest income is equal to 0.9% of the assets, because it's 0.9 over the 100 million. Then the final item is non-interest expense, and is 2.5% of assets in our example. So this consists of all expenses other than interest paid. So it includes salaries, technology-related costs, and other overheads. And in the case of all large businesses, they have a tendency to increase over time unless they are managed carefully. So banks must try to avoid large losses from litigation, business disruption, employee fraud, and so on. So the risk associated with these type of losses is known as operational risk, which will be discussed in chapter 23, although we are not going to look at it in chapter 3 when we don't cover chapter 23. So is there any question so far when it comes to the income statement and the balance sheet of the bank before we now analyze these statements when we look at capital adequacy? Any questions?
Hi, can you kindly just repeat the balance sheet again? I think I missed a few things.
All right, so these are the items that you find on the balance sheet. Remember, your asset side is on the left side, and then your equity and liability side is going to be on the right-hand side. Is there any item that you're not sure of?
No, so far I'm good.
Right. So remember, in the next analysis, that when we're going to be using these items now in the next analysis that we're going to be doing when we look at what capital adequacy and why we need to worry about capital adequacy. In the next section, they talk about capital adequacy. And then they say, one measure of the performance of the bank is return on equity. So tables 2.2 and 2.3 shows that DLC's before tax return on equity was equal to 12%. So how they are determining this return on equity is the return on equity is being given as the return on equity. In this case, they're giving it as pre-tax operating income divided by the equity capital. So that's basically how they're ascertaining this return on equity. So from the information that they give us there, remember they tell us that from the information that we're given, we see that our pre-tax operating income was 0.6 million, and the value of our equity was equal to 5 million. So if that is the case, it means, it basically means that our return on equity in this case is going to be equal to, so our return on equity is equal to your pre-tax operating income of 0.6 divided by your equity capital, which is equal to 5 million. Remember, you need to multiply that by 100 because the return on equity is always going to be a percentage. So how much would you get as the return on equity in this case? So if you do the calculation there, how much would you get as the return on equity?
$0.12.
If you multiply that by 100, you get 12%, isn't it? So currently, our return on equity, based on the information that we have, is equal to 12%. Then they go on further to say that if this is considered unsatisfactory, one way DLC might consider improving its return on equity is by buying back its shares and replacing them with deposits so that equity financing is lower and return on equity is higher. So that's how one way that they can be able to improve their profitability by looking at what? Improving the return on equity. So they say, for example, if it moved to the balance sheet, for example, if it moves to the balance sheet in table 2.4, where equity is reduced by 1% of the assets and deposits are increased by to 94%, its before tax return on equity would jump to 60%. Now, when you look at our financing of the business, they are basically saying, if the bank to improve its return on equity, if the bank basically, if the bank increases its leverage, so if the bank basically increases its leverage, where they're basically going to be having more deposits, 94 million, and then the equity amount becomes 1 million. So if they borrow more money and use that money to pay back owners of the business, it basically means that the deposits, so if they borrow money in this case by getting what? More deposits from the customers and using that money to repay the equity capital, it basically means that the equity capital is now going to be equal to 1 million and the deposits are now going to be equal to 94 million. Are we on the same page when it comes to this hypothetical example now?
Yes.
So to understand this better, to put this visually, we are saying our accounting equation says your assets is equal to equity plus liabilities. Now, if we rearrange this, we see that originally we were given that our equity was equal to 5 million. Our liabilities, in this case, which is basically your deposits. So your liabilities, which you made up of the deposits, were equal to 90 million, and the other liabilities, which is basically those that debt financing as well, was equal to an amount of 5 million. If we raise more money by getting more deposits to an amount of 4 million, and use this money to pay back equity capital worth 4 million, it means our equity capital is now going to be equal to 1 million. Our deposits are going to be equal to 94 million. And our other debt financing is going to remain at 5 million. Remember, on the asset side, we're basically saying our assets are equal to 100 billion. So we have now rearranged our financing structure, isn't it? We have now rearranged our financing structure. As we have now rearranged our financing structure, now we need to find out exactly, so what is going to be the new return on equity? So the new return on equity is going to be equal to the pre-tax operating income. Remember, the pre-tax operating income is not going to change. It's going to remain at 0.6 million divided by our equity capital is now going to be equal to 1 million. If you multiply that by 100, how much is that going to be equal to when it comes to the return on equity?
60%.
So which means in this case, by rearranging our financing, we're able to boost our return on equity from 12% to 60%. But what does that mean as well? Remember, we're saying this is where we take risk for the bank, isn't it? This is where we take, in our pursuit of generating a return for the bank, we're going to be taking risk on the assets as well. But we'll explain it later on, which is the concept that they're trying to explain in this case. But before we look at the effect of exactly how it affects the financial risk of the bank as well, from doing this, it would look good. And this is basically what banks are mostly tempted to do, to actually have less equity financing, be highly leveraged, so that they're able to boost their profitability as well. Are we on the same page so far? Any questions? Anyone lost?
So at this point, the company is 99% financed by debt and 1% by equity.
Yeah. Mm-hmm. The company being the bank, isn't it? We're looking at it from a bank's perspective. So from where we stand, the bank is highly leveraged because it's being financed by 99% debt and 1% equity. Because we have repaid equity through the increase in deposits that we have managed to get. Now, looking at this, they go on to explain it a bit further, and they say, how much equity does DLC need? This question can be answered by hypothesizing an extremely adverse scenario and considering whether the bank would survive Suppose that there is a severe recession, and as a result, the bank loan losses arise by 3.2% of assets to 4% next year. So we assume that the other items in the income statement in table 2.3 are unaffected. So now we need to find out exactly, so what is going to be the resulting pre-tax net loss? Now, looking at the resulting effect, we know that, so we look at it from a perspective of after and then before. And before these changes, we were told, so before these changes, we were told that when it comes to the income statement, we had the net interest income, which was equal to 3 million. And then we have loan losses, which were amounting to an amount of 0.8 million. And then we also have non-interest income, which was amounting to 0.9 million. And then we also have non-interest expenses that were amounting to 2.5 million. And this resulted in a pre-tax operating income of 0.6 million. So this is what we're given in the textbook, isn't it? So this is the information that we're given in the textbook. Now, in the hypothetical example, they are now telling us that let's assume that the loan losses, if you check on the loan losses, remember originally the loan losses were 0.8 million, isn't it? Now they are going to, which is 0.8%, 0.8% of the assets, but now they are going to increase to 3.2% of the assets, by 3.2% of the assets. So if they are increasing by 3.2% of the asset from 0.8 plus 3.2%, it basically means that these losses are now going to be equal to what? 4% of the assets, isn't it? And if these losses are now 4% of the asset, in the hypothetical example, we're now saying these loan losses are now going to be equal to 4 million. So these loan losses are now going to be equal to 4 million. And we're assuming that everything else remains the same. So we're assuming that the net interest income remains at 3 million, the non-interest income remains at 0.9 million, and the non-interest expense remains at 2.5 million. So given this information, how much will be the pre-tax operating income?
Minus 2.6.
So we get minus 2.6 million is the pre-tax operating income. Now, if we suffer a loss of minus 2.6, now we need to find out exactly, so how is it going to end up affecting the going concern of the bank? Remember, originally, when it comes to the balance sheet of the bank, we said our assets were worth 100 million, would be equal to 5 million plus this, plus that, is it? But now, we now rearrange our financing where we raised more money here from depositors and use it what to pay back the owners of the business of the bank in this case. And we're in pursuit of what? Increasing our return on equity. Now we need to find out exactly in that pursuit of increasing our return on equity, what happens to the bank if we end up suffering a loss of what? 2.6 million in that case. So in the text, they now go on to say, remember they say we are going to end up suffering a loss of 2.6 million. Assuming a tax rate of 30%, this will result in a net loss after tax, which is going to be equal to 1.8%, 1.8% of the assets. Now, in that case, remember we said after rearranging the financing of the business, we said our deposits are now going to be equal to 94 million. Our subordinated long-term debt is going to remain at 5 million. Our equity capital is now going to be equal to 1 million. And then our cash, marketable security, loans, and fixed assets are going to remain the same. Now here they say, in table 2.2, equity capital is 5% of the asset. So in after-tax loss, an after-tax loss equal to 1.8% of the assets, although not at all welcome, can be absorbed and it would result in a reduction of equity capital of 3.2% of the assets. Are we on the same page? Even a second bad year, similar to the first year, would not totally wipe out the equity. So remember, we're assuming that our tax rate in this case is equal to 30%, isn't it? Remember here we said our profit before tax was equal to 2.6 million, and here it was equal to 0.6 million, isn't it? Now, if our profit before tax is equal to that particular amount as well, now we need to find out exactly, so what is the effect of us on our profitability of the business? Now, to analyze this further, if we go on to say, if the pre-tax income is this, and our taxes are at 30%, it would mean 30% of 0.6 million, how much do you get?
$240,000.
It's going to be
Should be 0.24.
0.24, which would mean your after-tax profit is how much?
Should be 3.6, 0.3.6.
0.36.
Yes.
All right. Now, if our taxes are going to be equal to 30%, if our taxes are going to be equal to 30%, how much is going to be our tax benefit? If we suffer a loss of 2.6 million, how much is going to be our tax benefit?
Repeat the question, Menier.
What is 30% of 2.6 million?
Should be 0.78.
0.7. Is 0.78?
Yes, it is.
Remember, when you make a gain, SARS is going to tax you on that gain, isn't it? And when you make a loss, SARS is going to refund you on that loss. And we have what? A tax benefit, which is an inflow, which is going to be an inflow to us. Then how much is going to be your after-tax profit? How much do you get?
I got minus 1.82.
So you get on minus 1.82. In the textbook, they are rounding it up to 1.8. So please take note that in the textbook, they are rounding up this figure to 1.8. So this is where they are getting these figures, where they are saying this results in an after-tax loss of 1.8%. So if our loan losses increases to 4 million, our after-tax profit is going to be a loss of how much? Minus 1.8 million of the assets. Are we on the same page so far? Any questions?
Can you just repeat the reason why you said the 2.6 is subtracted from is negative? You said if the
When you make
tax
a
is
gain, so when you make a gain, SARS is going to tax you. It results in a tax liability to you, isn't it? So when you make a gain, SARS taxes you because it's the tax liability to you. But when you suffer a loss, SARS is going to refund you on that loss because you can claim back against those losses as well for tax purposes, which means it's going to be a tax benefit. So when you make a loss, SARS, it results in a tax benefit to you because you're able to claim this. But when you make a gain, it results in a tax liability as well. So that's why you see that for this particular amount, I was supposed to just put it in actually in brackets to indicate that it's a tax liability. Are we together? All right. Now, moving on, they also go on to say, if GLC has moved to a more aggressive capital structure, as shown on table 2.4, which is this one, where it's aggressive because we're having less equity and more money financed by deposits. 1 year where a loan loss at 4% of assets would totally wipe out equity capital and the bank would find itself in serious financial difficulties. It would no doubt try to raise additional equity capital, but it is likely to find this difficult when in such weak financial position. So it is possible that there would be a run on the bank and the bank would be forced into liquidation. If all assets could be liquidated for book value, the long-term debt holders would likely receive about 4.2%, 4.2 million rather than the 5 million, and the depositors will remain in full. Clearly, it is inadequate for a bank to have only 1% of assets funded by equity capital. Maintaining equity capital at 5% of assets in table 2 is more reasonable. So while they are saying this, please put your microphones on mute. Why they are saying this in this case is that, remember we saw that originally the financing of the bank was through equity of 5 million, 90 million in deposits, and then that long-term debt portion as well, right? So which means, looking at this, we know that the assets is equal to equity plus liabilities. Please put your microphones on mute. So we know that the assets is equal to equity plus liability. And before the capital restructure, please put your microphones on mute. So before the capital restructure, the makeup was that your assets was equal to equity plus liability, where your assets were 100 million and your equity in this case was equal to 5 million. And then your liabilities were made up of those deposits and money coming from other contributions as well, where there was deposits worth 90 million and this money of 5 million coming from there. So which means in this case, if we suffered a loss of, say, if we suffered that particular loss. So if we suffer the loss in this case, where our after-tax profit was equal to was minus 1.8 million, isn't it? It would mean a loss on the asset side of 1.8 million will have to be absorbed by someone on the financing side, isn't it? So a loss of 1.8 million on the asset side has to be absorbed by someone there who's doing the financing, isn't it? And naturally, we'd expect that these losses should be absorbed by the owners of the business. So the owners of the business would have to absorb this loss of 1.8 million. So which means in this case, the new balance sheet would look something like this. So we'd see that the balance sheet would be equal to, if you say 100 million minus 1.8 million, how much do you have? 100 million minus 1.8 million, how much do you have?
Then 8.2 million.
How much? How much do you have?
98.2.
98.2.
Also, you have 98.2 million. And then 5 million minus 1.8, how much do you have?
What's forward?
3.2.
3.2 million.
2 million here, and then we have 90 million there, and then we have 5 million there. So which means the 98.2 million left in the value of the assets is basically being financed by 3.2 million from equity, 90 million from depositors, and 5 million from those other long-term debt holders as well. So what do we see? This bank, in this case, is able to continue as a going concern. Why? Because the owners of the business were in a position to continue to absorb this loss and not affecting the depositors, which means that there will not be a run for the bank. Why? Because the depositors' money is still safe and secure. Are we on the same page? Now,
Right.
let's look at the scenario where we are saying we have now done the restructuring where our equity is not going to be 1 million, our depositors are not going to be 94 million, this is going to be 5 million, and then our assets are being equal to 100 million as well. So looking at this, we're saying our assets is equal to equity plus liabilities. For the assets which are worth 100 million, they are being financed by 1 million in this, and then 94 million from there, and then 5 million from there as well. Now we are going to suffer a loss of 1.8 million on the income generating activities of the bank. What does that mean? It means in this case, the owners of the business are not going to be in a position to absorb this full amount, isn't it? So they're not going to be in a position to absorb this full amount. And the maximum that they can absorb in this case is an amount of what? 1 million. So now, when it comes to subordination, the aim is to protect the depositors, which also means that in this case, the other 0.8 million is going to be absorbed by these debt holders as well. So which means the new balance sheet is now going to be equal to something like this. 100 minus 1.8 million, we have 98.2 million in assets that is left. We have 0%, 0 million in equity. We have 94 million in depositors. And then we have 4.2 million left from those long-term debt holders as well. So which means this bank, in this case, because they're keeping very little amount in equity, it means this bank is going to find it very difficult to continue as a going concern. Are we on the same page? Any questions? Anyone lost?
Sir,
Mhm.
can you repeat this after? I want to understand it. I'm lost. So.
All right. Remember we said in pursuit of maximizing the return on equity, right? The bank decided to raise more money through deposits, money from the depositors, and use that money to pay back the owners of the business, so that they are only left with the equity capital of 1 million, isn't it? Are we on the same page? But now depositors' money is going to increase to 94 million, and then this is going to remain the same, and this remains the same. Now we're trying to demonstrate to see exactly, so why is there so much emphasis on banks when it comes to capital requirement? So we're trying to demonstrate the emphasis and why there's a lot of regulation when it comes to capital requirement for what? For banks. Reason being, if we suffer loan losses of 4 million, right? If we suffer loan losses of 4 million in this case, what is going to happen? Our after-tax profit is going to end up being minus 1.8 million, isn't it? Now, if we were financed by the first capital structure, which is the one that we have here, and we suffer a loss of 1.8 million from our income-generating activities of the bank, we are going to have enough capital available to absorb these losses and still be able to continue as the going concern, because there is still equity capital available to finance the bank. So there's something coming from the owners from the equity holders, and because of that, the bank is able to continue as a going concern. Are we on the same page? We now look at the effect of losses before we do the capital restructure. Any questions?
Okay,
Now,
but sorry, we said that it is preferred that you have less equity and high leverage. However, when we did these calculations, we just noted that with banks that have less equity and high leverage, they're less likely to continue should there be a loss after tax.
so what this example is trying to demonstrate is the reason why there is bank regulations which state the minimum capital the bank must keep on its book. Remember, we're going to look at this in detail when we look at the Basel Accords. And normally in South Africa, the capital requirement here is 10% of the financing. So the reason why the bank must maintain high levels of equity capital is mainly because if there are losses, there's going to be financial problems for the bank. Although for the bank, their aim is to maximize shareholders' profits, so they are going to be tempted to decrease their equity capital, so that if they decrease their equity capital, they're able to maximize the return on equity. That's what the bank will be tempted to do. But the reason why there's a lot of regulation of the bank, especially when it comes to minimum capital requirement that the bank must maintain as regulatory capital, is mainly because if there is no regulatory capital that the bank must maintain, they're going to be tempted to have as minimum equity available as possible. And the problem of having minimum equity capital as possible is that if they suffer losses, if they're having a lot of capital available and they suffer losses, they'll be able to continue as a going concern. But if they have very little capital and they suffer losses, they're not going to be able to continue as what? As a going concern. So that's what this example is trying to demonstrate. Why banks are heavily regulated, especially when it comes to minimum capital adequacy for regulatory capital purposes. Are we now on the same page?
Yes, thank you.
So this is the reason why you find that, especially in South Africa, the banking system has been very solid. That's why you see that even when you look at what happened during the 2008 financial crisis, the South African banks were not really that much affected, although they were affected, but they were not as badly affected if you compare how the American banks were affected as well. Reason being, American banks, because they lobby for deregulation, why? Because they're trying to fight this minimum capital requirement of maintaining high capital amounts, because if they maintain low capital amounts, they're able to maximize profits. So American banks, normally, they are always trying to fight for deregulation, because if they fight for deregulation, they're going to be able to maintain minimum amounts of capital. And if they maintain minimum amounts of capital, they're going to be what? Able to maximize the profits. But the problem now is that maintaining minimum amounts of capital means that if there are going to be losses there, the bank's capital going concern is going to be affected. And one of the issues, that's why you see that if you look at the discussion of American banks as well, is that many people are complaining that these banks, they are fighting for deregulation, for them to maintain very low amounts of capital, because they know that whenever they are faced with this situation, they'll just go to the bank and ask for a bailout. So that's the issue that banks are always fighting for. And that's the dilemma that many regulators are also faced as well, where they try to push as much as possible for regulation of maintaining a huge amounts of regulated capital, which is basically the minimum capital that the banks must maintain, mainly because if the banks maintain value to capital, they're going to be facing with this situation, and they are going to be having a threat on their going concern. And if banks face a threat on their going concern, it means there's going to be very little confidence in the market. And remember, the financial system in itself, by nature, is based on what? Confidence of the customers. The less confidence the customers have, the less they're likely to deal with the financial system, which basically means that now, if someone is going to prefer to put money under their pillow instead of putting that money in the bank, what is going to happen? There's less circulation of money. And if there's less circulation of money, they're finding a situation where the people who have excess funds are not giving the financial institutions so that they can distribute to parties who have what? Deficit of funds as well. Are we on the same page? Any questions? Anyone lost? So the last thing that we're going to be looking at today, which is very much related to the issue where we see that, yes, is there a question? Is there a question? All right. So the last thing that we're going to see, which is related to this example that we've looked at now, is the issue of deposit insurance. Is the issue of deposit. Okay, before we go there, they also say as a note, as we shall see in chapters 15 to 18, bank regulators have tried to ensure that the capital a bank keeps is sufficient to cover the risks it takes. So the risks include market risk, credit risk, and operational risk. So these are the risks that affects the value of the assets. So they're going to be taking operational risk, market risk, and credit risk as well, which may result in these losses. So which means they have to make sure that there's enough capital available to absorb these losses that arise from what? All these types of risks that they've mentioned here. So in section 2.6, they say, to maintain confidence in banks, which way we look at deposit insurance, government regulators in many countries have introduced guarantee programs. These typically ensure depositors against so these typically ensure depositors against losses up to a certain level. And from the US perspective, when it comes to this issue of deposit insurance, please take note that in South Africa, the last time I checked, which was last year around this time as well, they had not yet propagated the deposit insurance. It was still being gazetted and also going for final draft as well. I'm not sure if they've actually imposed this when it comes to the banks, when it comes to deposit insurance. I'll need to check as well.
Yeah,
But
it's been approved.
it's not yet. Sorry,
It's
been
been
approved.
yeah, and it's been set in motion. So it is
Oh.
in operation.
All right, so that's good. So it means with deposit insurance, it basically means that it's basically that insurance that tries to, because remember, when you look at the bank's operations, remember we said the idea is we are trying as much as possible to protect these depositors as well. Because remember, a normal person who's got no understanding of the financial system or the risk that the bank is going to be taking as well, they are saying in their mind they are giving the bank the money, and when they want that money, they are going to be able to get that money as and when they need that money as well. So in cases where the banks now are going to be suffering these losses as well, the issue of the deposit insurance is basically to ensure that what the depositors are going to be able to cover their money, even when the bank is going to be suffering such a situation where its going concern is going to be affected as well. And one of the issues that push for this as well is where we saw the case of what VPS banks as well, VPS bank, where a lot of depositors were also affected as well. Now, looking at the issue of deposit insurance, they say, when you look at it from an American perspective, they say between 1980 and 1990, bank failures in the US accelerated. There were several reasons for this. One was the way in which banks managed interest rate risk, and we will talk about it in chapter 9. Another reason was the reduction in oil and other commodity prices, which led to many loans to oil, gas, agricultural companies not being repaid. A further reason for the bank failures was that the existence of deposit insurance allowed banks to follow risky strategies that would not otherwise be feasible. For example, they would increase their deposit base by offering high rates of interest to depositors and use the funds to make risky loans. So without deposit insurance, a bank could not follow this strategy because its depositors would see what the bank is doing, decide that the bank was too risky, and withdraw their funds. So with deposit insurance, it can follow the strategy because depositors know that if the worst happens, they are protected under the FDIC as well. So this is an example of what is known as moral hazard. We will talk about moral hazard further in chapter 3. So it can be defined as the possibility that the existence of insurance changes the behavior of the insured party. So the introduction of risk-based deposit insurance premiums has reduced moral hazard to some extent as well. So that's another issue that they also are taking into account when it comes to deposit insurance as well. Although wouldn't really be working much about it because there's quite a lot more regulation as well when it comes to the banks, where they're maintaining higher amounts of risk-weighted of 10% of the risk-weighted asset, which basically means that more or less there would be they are not going to be maintaining any lower amounts of those risk-weighted assets as well. And because of that, it basically means that it would come in very handy when it comes to deposit insurance because at the end of the day, the banks are still going to be regulated to maintain high levels of risk-weighted assets when it comes to the capital requirement as well. 10% of the risk-weighted assets so that they're able to have enough capital to absorb those losses in case those losses happen as well. Are there any questions on what we've covered today? Any questions? So today we have looked at commercial banks. In the next class, we're going to be looking at section 2.4, which looks at what? Investment banking as well. So which is going to be the last section of chapter 2. So on the last section of chapter 2, that's where we're going to be looking at investment banking. Then from there, we move on to chapter 3, which is still part of learning unit 2, which looks at insurance companies. So we also look at insurance companies, which is the still part of chapter learning unit 2. Then after analyzing insurance companies, we move on to chapter 4, which is still part of learning unit 2, where we're going to be looking at what? Mutual funds, exchange traded funds, as well as hedge funds as well. And remember, all these 3 chapters, chapter 2, chapter 3, chapter 4, they are all part of learning unit 2. Are there any questions? So please note that mhm.
Hi, Rhinus. I wanted to find out, are you doing your lessons only on Saturdays or in the week as well?
Only
I am.
on Saturday. Please note that our timetable is available. So just check on your different WhatsApp groups. So you should be able, if you're not yet able to access our timetable, please just ask your administrator on your WhatsApp groups as well. They should provide you the timetable, because already we know when we are going to be meeting for our classes between now until end of October, because that's when we should be done with the different study units. So the timetable of when we're meeting, at what time we're going to be meeting as well, the timetable is already available.
Okay, thank you for that. So are you covering 03, 04, 05 only? You do not do 01 and 02?
Yes, but check with your administrators. They should be able to assist you with someone who can assist with 01 and 02.
Okay, thanks.
All right. Are there any other questions? All right, if there are no questions, enjoy the rest of the weekend. Please note that by Monday, we would have made this video available so that in case there's something that you want to go back to, or maybe you missed part of a class, you should be able to access this video as well, so that you can also use it as part of your revision material. And please try as much as possible to ensure that you're able to create the user account on our website. Consult your WhatsApp administrators to show you exactly how to create the WhatsApp to create user account on the website as well. Because on the website, you are able to access the soft copy of the textbook, and you're also able to use last year's video to prepare for the coming classes as well, so that if you are able to study in advance, it means that when we go through the class as well, you will be able to ask questions on those sections that you don't understand. And that way, you will see that during revision, you are not going to be spending so much time going through these sections as well, because you'll be having a better understanding anyways, and you've already covered and understood those different sections. So try as much as possible to utilize the videos that we have covering these sections from previous year, because if you use these videos, you are going to be able to now ask questions in the coming classes and be able to have a better understanding as well.
Rhinus,
All right.
Rhinus. So the
Yes.
last week one's videos are already uploaded.
They will be there. Those people, those who had not already created the user accounts on the website, I did share the link to those videos, but I'll make sure that they're also uploaded and make them available as well.
Okay, you can also share the links if it's available.
All right, I'll do that. But remember,
Thank
from
you.
this weekend or this week's class onwards, I'll make sure that I link these videos on the user account so that you're able to access these videos as well. Yes. Is there a question?
Okay, thank you.
Reno, can you
Mhm.
maybe just quickly share? I've seen some messages. I've only joined these groups today about paying for lessons and whatnot. I'm just not sure. For your lessons going forward, do we need to pay for this, or how does it work?
Yeah, yes. What we do is that for each module, we charge 2,500, payable between now until end of December. But please check with your admin group, the one that you're chatting with on WhatsApp as well. They will be able to give you that information as well. So just chat with your administrator on your the ones that you're communicating with on WhatsApp. They will be able to provide you with that information.
Thank you very much.
All right. Are there any other questions? All right. If there are no questions, enjoy the rest of the weekend.
Thank you. Bye.